Turn on the news and you'll hear endless chatter about a looming housing bubble. It's like déjà vu, isn't it? Memories of the 2008 crash are resurfacing with predictions of a similar market catastrophe in 2024. But what if this isn't a disaster in the making, but a golden opportunity? Picture this: buying a $200,000 house for just $70,000. The allure of real estate investment is undeniable. There's this seductive notion that property prices only escalate, but history begs to differ. It's a roller coaster ride filled with peaks and troughs. So, is now the right time to jump on board? To answer that, we need to delve into some critical questions. Do home prices perpetually rise? What causes housing bubbles to form? When might we witness another market crash? To truly grasp if investing in real estate now is wise, we need to dissect a few critical questions. Let's rewind to 2008 for a clearer picture. The Federal Reserve's interest rate policies played a pivotal role in setting the stage for the crash. After the dot-com bubble burst, the Fed slashed rates to stimulate borrowing and spending, an attempt to kickstart the economy. But this move had unintended consequences, especially in the real estate sector. Investors seeking greener pastures shifted from stocks to real estate. Financial institutions, spotting an opportunity, started bundling home loans into investment shares. These initially seemed foolproof, but as banks loosened their lending criteria, extending credit to less creditworthy individuals, the risk escalated. The domino effect began when these homeowners started defaulting on their loans. The market was suddenly flooded with unsold homes, causing prices to plummet. Banks left holding worthless loan-backed shares started failing. The result was a financial crisis that rippled through the entire economy. When homeowners began defaulting, the market flooded with unsold homes, causing prices to plummet and banks to fail. Fast forward to today, and we're facing a different landscape. The housing market has evolved dramatically since the 2008 crash. Banks have tightened their lending criteria, making it harder for those with shakier credit histories to secure mortgages. This is a stark contrast to the pre-2008 era, when loans were handed out like candy at a parade. The Federal Reserve has also played its part. Interest rate hikes have been implemented in an attempt to cool the market, slowing the rate at which house prices are rising. But it's like trying to slow a freight train with a feather. Prices are still climbing, just not quite as rapidly. Then there's the elephant in the room, the pandemic. It's thrown a wrench into the gears of the global economy, adding a layer of uncertainty to an already complex situation. Remote work has boosted demand for homes in suburban and rural areas, driving up prices in markets that were previously more affordable. But as with any market, there are risks and uncertainties. High house prices, combined with the potential for an economic downturn, could lead to price corrections. Overvaluation is a real concern, and there's always the possibility of another bubble forming. The housing market is like a game of musical chairs. No one wants to be the one left standing when the music stops. For those pondering an investment in real estate, it's a risk-laden decision. The key is to do your homework, understand the risks, and make informed decisions. Another factor to consider is the persistent undersupply in the housing market. This scarcity isn't just causing prices to skyrocket, it's also reshaping the very dynamics of demand. The market is increasingly becoming a playground for investors, with home ownership slipping further down the priority list. This imbalance between supply and demand is fueling an alarming trend market speculation. Investors, driven by the notion of scarcity, are buying properties not for their intrinsic value, but in the hope that prices will continue to rise. This speculative fever can inflate prices beyond their true worth, creating a precarious bubble that could burst when least expected. Overvaluation is another concern. With prices reaching sky-high levels, the risk of a correction becomes ever more present. The market is like a seesaw, and the heavier the overvaluation, the harder the fall can be. In this overheated environment, if you're not a seasoned investor, diving in might not be the best move. In conclusion, while it's tempting to try and time the market, the unpredictable nature of real estate makes it a gamble. The current landscape is a tightrope walk, and the decision to invest is laden with risks. Remember, market speculation and overvaluation are real concerns. Thanks for tuning in, and don't forget to subscribe for more weekly investment insights. Happy investing, but remember, tread carefully.